Hello, everybody. Thank you for coming to today's event. My name is Ryan Nash. I'm from Gust. I'm the CEO at Gust. Joining me today is, I think, somebody I can call my good friend, my good professional friend. I have seen him in person in a both vaccinated, not Kentucky, but Nashville situation a couple weeks ago. But Stephen Platford, one of the co-founders from Forecastr. We've been doing an event series from Forecastr, honestly, over the past year. And we're probably going to keep it going because all we do is get incredibly good feedback from people. It hits at a really good stage in a startup's life cycle. And a number of you are Gust launch customers, so you know that over the first year or two of your startup, you eventually get to the point where you need to put together financial projections to communicate not just to investors, but we're going to focus on investors today, but to anybody joining your company, like where you're going, what's the trajectory, what is the actual projected future of the change that they're trying to make. And we have found that the team at Forecastr, who are still a startup themselves, but provide tremendous value to both our customers and the larger Gust ecosystem. So I'm going to try to stop talking soon, but hand this over to Stephen, who is going to do a solo presentation today. Normally we have him and his co-founder here, but to run through financial modeling in general, not just a product demo, but they totally have their product, which is a really nice way to do projections, but how to specifically think about financial projections with investors. And spiritually aligned as we are, we like to see get your stuff done and ready up front so that you're not scrambling when good things do happen in your startup. With launch, we take care of your back office. Forecastr can help with your financial projections. So without further ado, Stephen, give us a little bit of your background and then take it away. And before I give it to Stephen, I'll run the kind of Q&A and management and stuff. So anytime throughout the presentation, if you have a question, feel free to use the chat or the Q&A. There are panels that you might have to extend in the GoToWebinar thing. If a thing is contextually relevant, I'll serve it up while Stephen's talking and interrupt him awkwardly through video chat. And if it's more specific or you can just wait to the end, I'll let you know and we'll do some Q&A at the end of the presentation.
Yeah.
All right, take it away, Stephen.
Awesome, Ryan. Thank you, my man. And yeah, should be plenty of time for some Q&A at the end, but definitely don't feel any certain way about just throwing it out there and interrupting me. I love to just answer the questions as they come. And yeah, guys, it's great to be here. I'm very honored, honestly. Like, we've been very lucky, I think, to have Ryan and Peter and the whole Gust launch team as good friends and partners of ours. And yeah, just love talking about this stuff too, because I think it's just an area where, at least in my career, I've seen a lot of founders struggle with, and that is just building and managing a financial model. It's using one to raise capital. It's using one to run their business. It's just tricky. It can be really tricky, but I think we can really kind of break it down in a way that hopefully feels a lot more actionable, a lot more achievable, and really sets you guys up for success. So I'm really excited to talk about that. This kind of stuff today, and before I do, I will just tell you a little bit about me, because I think it's important that you understand, who am I and what gives me the right, so to speak. So I'm Stephen Platford. I'm a serial entrepreneur from Louisville, Kentucky. I've been in the startup game for about 10 years, and I've started 2 companies now. So I can't say I'm a serial entrepreneur, which is pretty cool. But I've started 2 companies. I've taken them both through Techstars, so that's pretty neat as well. I started a consumer company back in 2013. I ran it for 3 years, took it through Techstars in Austin, and then I'm running a company now called Forecastr, and we do online financial models for startups. I've been through Techstars as well, and over the course of those 2 companies, I've raised just over $5 million in venture capital. Personally, I've helped some of the companies that I've worked with raise about 20 to 30 million. So definitely people out there that have raised a lot more venture capital than me, but I've raised a decent amount of money. I think I can help you guys out in that way. I've also built a lot of financial models. I've built easily over 200 financial models for companies of all shapes and sizes. So if a financial model is what you want to build, I can definitely help you get that done. And in between the 2 startups that I founded, I was a fractional head of finance for a few dozen startups and really helped them do a lot of this as well. So yeah, financial modeling and fundraising, these are topics that I definitely can speak to really well. A lot of topics that I can't. And Logan is my partner in crime, my co-founder and COO, and you can see some of his stats, but he's a great guy also. So yeah, we would love to help you, whether you use Forecastr or not. We'd just love to help you make sure you get a great financial model for your company. And just so you know kind of what Forecastr is, it's an alternative to Excel when it comes to building and managing and presenting a financial model. It's an online financial modeling platform that helps founders build great financial models online. And I think it's really interesting. There's a lot of benefits to it. We won't dwell too much on the benefits of Forecastr, so to speak. But if you want to check Forecastr out and you're interested in working with us, you can go to forecastr.co. You can sign up for our beta. We've got a great guy in Mitch Fangalo who will give you a demo and help you get started. We work with dozens of Gust companies, and they've been, I think, really grateful for the support that we offer. So we'd love to work with any of you guys as well if it's something that you're interested in. But everything that we talk about today, like Ryan said, is stuff that you can do regardless of if you use Forecastr. I want you guys to know that as well. If you decide to use Excel to build a financial model, all of this information absolutely applies. It's the way that it's been done for a while. So definitely know that if you decide to use a spreadsheet, like, that doesn't mean you can't leverage us. We'd still love to help you. We'd still love to make sure that you guys do this stuff right and increase the chances that you get those checks. So that's a little bit about Forecastr. As far as the agenda for today, the first thing I want to do is align ourselves on the power of a great financial model. This is kind of the why. It's like, what is a financial model? Why do we build it? There's a little bit of a spoiler on the screen here, but it helps you raise money, helps you run your business. Once we kind of all agree on what a model is and why we should build one, the rest of this talk assumes that you have a model. So we're not going to talk a lot about how to build a model or that type of thing. We're going to talk about how to use one. So once you've built it, which is a big piece, but once you've built it, you got to use it. You've got to figure out, how do I actually take that model and use it when I'm talking to investors to increase the chances that they invest in my company? And that is what we're going to unlock for you today. I think it's really actionable, this talk is, and we're going to spend the first half of this talk conceptually talking about how do you use your model in a pitch deck. Everybody's got a pitch deck. How do we use the model in the pitch deck to supercharge it? How do we present our model to investors? One of the things we're going to talk about is that models should be presented. They should not be shared via email and things like that. We'll talk more about that. But the other half of this talk is going to be really experiential. We're going to actually drive into my financial model, my actual financial model for Forecastr, and I'm going to walk you guys exactly how I presented my financial model to investors earlier this year. In Q1, we raised a $2.5 million seed round for Forecastr. We've raised $4 million to date. We've got 250 companies now, over 35K in MRR, and a team of 23. So I'm really proud of that. And we raised $2.5 million in Q1. We were fully subscribed in 6 weeks. And everything that I'm going to talk about today, I put into practice in that round to make that happen. And I think you guys can achieve really similar results. So we're going to actually do a mock investor meeting. We're going to actually walk through my model. I'm going to give you a little bit of tips and tricks on how I walk through it and kind of pause along the way. So yeah, that sounds good to everybody. That's what we're going to do. So
wait, do I have to be the mock investor? Should I go get a turtleneck or
yeah,
maybe
if you
a
get you a
vest?
Patagonia and some Allbirds, and you'll be good to go. But yeah, I would say when we get to that piece, both Ryan and everybody in the audience, I think you guys can both be the investors, and I want to get some really tough questions. Don't hold back, fire them at me. We'll see if I can impress you guys, right? And that's a big piece of it, right? It's like you've got to be prepared for the tough questions when you're presenting a financial model, and you never know what those questions are going to be. So you got to be able to think on your feet. You got to really know your business, and we can do kind of a mock environment on that today. I'd love to do that. But first things first, what is a financial model? It's a term I think that a lot of people use in different ways, and there's an analogy that we like to use when talking about what a model is, and that's an automotive industry analogy where this is essentially how cars were built in the 20th century. It was pretty insane. They built them with clay, 8-scale model. They would build an entire car really with no real knowledge of if it was really built to spec, so to speak. Like it was kind of a hand wavy type of thing. And then they put some brave soul in the car and they'd say, hey, take it around the track, see how it performs. Maybe it flips, maybe it spins out, maybe it does great. We don't really know. Just get in there and give it away, And not exactly a very efficient process. Usually they'd get something wrong, they'd have to reiterate on it, and then it would take months and cost millions of dollars, and people would get hurt, and all these negative things. And today, it's kind of funny to think about cars being built in this way because we have software. We build cars with software. We build them with CAD systems. We put them on a virtual test track, and these systems know all the mathematics behind the car and the underpinnings in the car, how it works, how it performs. And so you can iterate very quickly in a series of days, maybe weeks, not months and years, and you save millions of dollars. It's a lot more efficient, and nobody gets hurt. And this is ultimately what it's like when you're running a company. If you run a company without a model, without any real knowledge of if your business is going to work, it's very likely that it doesn't end up actually working, and you can lose a lot of money, a lot of time, and a lot of emotion and energy. But if you build a model, it's like having a simulator. It's like taking your business on a virtual test track. You can avoid the potholes and the pitfalls before they actually occur, and you can really drastically increase the chances that you have success in business. And so simulating your business in this way, simulating your revenue and your acquisition and your expenses and your cash, all of this stuff forward to make sure before you put in all the time, energy, and effort that you've actually got a solid business and you have something to build, I think is really critical. And ultimately painting that picture and telling that story of how you're going to get from kind of your current state to the pot of gold at the end of the rainbow is really, really critical when you think about getting an investor to invest in your company, and getting an investor to invest in you. They want to have trust in you, they want to have confidence in you, and that comes from you really kind of backing up, the story that you're telling maybe in a deck. So that is what we think of as a financial model. It's a simulator. It's not a crystal ball, but it is a question and answer kind of exercise. It doesn't just tell you all the answers, but it can help you answer some of the toughest questions about your business in a very data-driven way. It can help you understand how much money should you raise. When I raised $2.5 million, it wasn't because I just thought, hey, maybe I'll raise $2.5 million. It was because that was the amount of money that I needed, including a buffer, very important, including a buffer, that I thought would give me 24 months worth of runway to get from where I was when I raised the round, which is about $8,000 in monthly recurring revenue, to 100 to 150K in monthly recurring revenue by the end of 2022. That was my milestone. So I was able to back into how much money do I need to raise in order to hit those milestones by saying, how am I going to spend that money? Who do I need to hire? When do I need to hire them? Who can I afford and when? What acquisition channels am I going to focus on? What's going to be the results of that? How much is that going to cost? How much revenue can I generate from that? How many customers do I need to hit that 100K in MRR or $1 million in annual revenue? Like, what are my goals need to be? Your goals should be kind of a mixture of like where you need to be. You got to be this tall to ride this ride, versus what is reasonable, right? You should kind of come at it from both sides and what you believe you can do. And a model is going to help you really anchor that and anchor your goals in reality while kind of reaching for those milestones you need to hit. So it's really going to help you answer a bunch of questions. But one question, actually I'm jumping ahead, and I'll talk about this first, then we'll talk about how to use it in the pitch deck. So this is really important, and I think something that a lot of people don't really recognize right now, and that's that we're living in kind of a world where if your company is at the pre-seed or seed stage, so if you are kind of pre-series A, if you've either raised no money and you're raising your first round right now, or maybe you've raised like 100 to 250K and you're looking for 500K or $1 million or even up to $3 million. I raised a $2.5 million seed, so you can raise a bigger seed these days. Like if you're raising anywhere from, I'd say, 500K to 5 million, you're actually in a really awesome spot right now if you build a great financial model, because it's not commonplace. Like a lot of founders are doing it, and it's happening more and more and more, and that's great. It's great for everybody. It's great for outcomes. It's great for investors and founders and us as well, obviously. But like, it's still not the norm. Like there's a lot of people that are going out looking for funding without a financial model, and that's an opportunity for you as a founder, because when you're approaching an investor, the vast majority of the time, the investor is going to say no. They have to. They just see too many pitches to say yes all the time. So if they're going to say yes to you, by definition, you've got to be an outlier. You've got to separate yourself from the pack. You've got to be head and shoulders above the rest. And building a great financial model is one of the ways that you can do that, because an investor is a finance person. They speak the language of finance, and a great financial model tells your story in a crystallized way, in a way that makes sense to them and resonates with them, because it's the language of finance. And so building a great financial model is really a tool in your arsenal to separate yourself from the pack and really drastically increase the chances of receiving investment from these investors. We've helped a lot of founders do this, and I would say that founders that have a great financial model versus ones that don't, I would say double or triple their close rates of investors if they can not only have that model, but really articulately walk an investor through it. And that's what we're gonna talk about in just a second. So
can I interrupt you real quick, Stephen?
Please, yeah, please do.
Before you move on, because especially our audience here might have attended some of our other events or office hours, and something we stress all the time, and to Stephen's previous point, is people ask us, like, how much money should I raise? Often it's like, as much as I can, and that's, what we're always saying is back into what you need, is because the amount of money you need to raise, if you can get away with none, is the best deal for the company and everything, and the hassle in the business. But setting that value is not just looking at what other companies raise, just looking at the valuations you see in the startup news, but it's really like, how do I come up with that? It's like just as much as you need, and then a little bit of a buffer for time, and that just as much as you need. A financial model is probably one of the best structured ways to actually convince yourself what that total is, so that you're not going out basically heavily diluting yourself in your first round or future rounds, or running out of cash when you do raise something and don't realize, like, oh, I needed to hire twice as much, or cogs go up, whatever case of your business is.
Yeah, very well said. Very, very well said. And on the Series A side, for any of you that are a little bit farther along, it's just good to recognize that it's really table stakes at that stage, especially these days. If you're going out for a Series A, it's really competitive. A great financial model is just absolutely one of those things where you've got to have it in order to raise that round. And so the better the model, the more that you might be able to separate. But it's absolutely something that you should expect to be asked very critical questions about at a Series A. So make sure that you go in there prepared. I think to Ryan's point earlier, you make sure you're getting this stuff done on the front end so that you're really shining when you get into that process. If you show up to the table with a financial model, a data room, your cap table's on point, like you really understand your business, you've got a great deck, like you're really buttoned up, you are going to drastically increase the chances that you receive that investment, because you're showing the investor that you're on top of it, you're a great communicator, you're a great executor, and they know that it's that type of organization and execution that is what it takes to get it done. And so, we get asked a lot by all our customers and a lot of the founders that we advise, like, okay, I know I have a pitch deck. Everybody's got one of those. Now I've got a great model because either you helped me do it or I did it on my own. How do I synthesize those? How do I use those together? Where do those overlap? And that's a big piece of it. They're both storytelling tools, and you really want to leverage them both in that way. And so in your deck story, which to me is kind of the charismatic expression of your narrative, you just want to tease the investor with financial projections. So you're not looking to include all the information about your model or overwhelm them with information or anything like that. You're trying to set the hook. You're trying to bait them. You're trying to just tease them with some projections. So I like to call it some sexy stats. You're going through your deck. You're talking about your team and your vision and your market and your opportunity, your business model. Near the end of the deck, I would say almost at the end of the deck, throw in some financial projections that is just meant to kind of tease out an investor to say, like, that looks pretty exciting. Like, I really think that is a pretty solid business. Where did you get those numbers? You ultimately want an investor to ask, where did you get those numbers? That's what you're baiting them into. That's what you're trying to set the hook on, because you're not trying to sell them completely on all the numbers. You're trying to keep it high level, convey the potential, and bait them into asking that question, which is falling into your trap. You're going to say, oh, you know what? I've actually built a great financial model for my company. I really understand my company. We're a data-driven culture. I would love to walk you through my financial model and get you really, like, trained up on kind of how we do business, how we acquire, how we monetize our hiring plan. We put a lot of thought into it. We recognize it's just a model, but I'd love to walk through that with you and really get you up to speed on our business. And I will tell you this right now, like the investors that take you up on that and sit down with you and you crush that meeting, they are gonna invest in your company. We've seen it happen time and time and time again. And the investors that don't take you up on that, they're like, oh no, maybe I don't want to see your model, or I'm too busy, or just send it to me in email and things like that. Like they're not that interested. So really hold your ground, force that meeting, and that's what we're going to talk about next. Is that's where the rubber meets the road. A great model is really best used live. Like when you actually present a model, that's where all the magic is, because especially when you're early stage, but I would say at the pre-seed, seed, or Series A, the investors care a lot less about the actual numbers in the model and a lot more about, can this founder articulate how their business works? Does this founder seem to know how they acquire, how they monetize, the people they need to hire and when, why they're hiring those people, how much money they need to raise? Can this founder answer the tough questions about their business? And is this founder going to be a good shepherd of my hard-earned money? Like that's what they want to know. And they don't get that by reviewing a model in an email. They get that by watching you present the model and engaging with you in a meeting. So that's what we want to do. And we're going to talk a little bit about conceptually how we do that. And then we're going to dive right into my model. I'm going to show you exactly how to do that. I'm going to show you exactly how I did it to raise $2.5 million in 6 weeks. So here's kind of what we think about, high level conceptual. Before the meeting, I'll hit on it again. Don't send it via email. Just don't do it. People will ask you to do that. They will. They'll say, I've seen a million models, just send it to me. Don't do it. And there's a very specific reason for that. And anybody that's ever engaged in a political conversation at Thanksgiving is going to understand this one. When you are a human and you form an opinion, you deep root yourself in that opinion. You don't want to change it. You just camp right there in that opinion. It's very difficult to change. And so when you share a model with an investor via email, they're going to form an opinion about your business. They are going to open that email, they are going to look at that model, and they're going to form an opinion about your business. And you're not in the room to shape that opinion in a way that's favorable to you. You're not in the room to see when their face crinkles up and say, oh, well, seems like you might be dubious about that point. Let's dig into that. What's your concern? Like you don't have any control over that. And then by the time you do meet with them, they're deep rooted in a camp and it's hard to move. I've been there. If you're walking them through the model, you can see that and you can head it off and you can spin it, you can shape it, you can form their opinion in a way that's favorable to you, and you're going to drastically increase the chances that they invest. Now, when you're in the meeting, it's very important to walk a fine line. You want to be very coachable, you want to be in control, so you kind of have to walk this line of being very confident in your model and your projections and kind of like the model that you've built in your understanding of your business, but also understanding that it is a model and that you are coachable and that you could be wrong and that these are just assumptions and that you're going to spend the hard work day in and day out validating or invalidating your assumptions in the market. Investors want to know that. So I think a very important point of when you're in the meeting is it's not you and the model versus the investor. It's you and the investor versus the model. The model is not the enemy, but the model is the other side of the table. You're working with the investor. You're giving them a preview into what life with you will be like if they make an investment in you. And you're working with them to say, hey, here's the model that we've built. It's a model, it's just a simulation of our business. We think we've loaded it up with very reasonable assumptions based on historical data and industry insight and a little bit of gut. And we believe this model reflects our business. We believe it's an exciting outcome for our business, but it's a model. Like, let's look at it. Let's play around with it. Let's fudge around with it. Like, look how well we understand our business. So that's really what you want to do when you're in the meeting. And then after the meeting, the fortunes in the follow-up. Diligence is king when it comes to fundraising. Like, if you are on top of your game and right after that meeting, boom, you hit them with a follow-up email. Thank you so much for the email. Little ego stroke, never hurt anybody. Maybe a link to their data room. Bam, right there. It's got everything in it, super tight. And you've got even a copy of the model in the email. That's fine because you've already shaped their opinion. You've already formed it. You can share it with them afterwards. If you use Forecastr, you'll get an investor access link. It can be public, it can be private, it can be password protected. you can throw that link right in there along with the data room, and they can click that and view only, check out your model. So there's lots of ways you can share that model with an investor. But hit them with the follow-up, and always set a defined next step. So when you're done with any meeting, I don't care if it's a pitch meeting, a model meeting, a technical audit, co-founder meeting, whatever, you want to set a next step. Oh, thank you so much for meeting. I heard that you want this piece of information, or I heard that you need 2 weeks in order to make a decision, and then we'll come back to the table. We'd love to have you in the round. We just got another 50K commitment. Like you want to set that next meeting or that next step so that you don't just leave it hanging out there and it's just going to go on and on and on, because fundraising is all about momentum. It's all about scarcity. That happens by running a really tight process and frankly playing investors off of other investors. So you really want to keep it tight, and setting a defined next step is a great way to do that. And the other piece there is that communication is so critical. Investors want to invest in founders that communicate very well. They recognize that as a CEO, communication is one of the biggest pieces of your role. And if you can't communicate well, and you can't lead a meeting, and you can't set a next step, that's going to tell the investor something about you as a founder, and it's not what you want them to know. So definitely take a point to do that as well. Yeah, that's the conceptual piece. So I'll do a quick pause here to see if we have any questions we want to dive into, because it's a natural kind of break before we dive into actually walking through my financial model. So Ryan, we have anything we want to talk about now, or should I dive in?
I was going to save it to the end, but we had a couple questions along this, excuse me, bent in the beginning and throughout. So maybe we'll take a brief pause to address this. So both Stanley and Carlos, and I'm sure it's on everybody's mind based on what we're talking about, are asking, how do you actually find investors or investment groups? And I know this isn't the focus of the webinar in general, but this comes up all the time. So I'll give a little bit just from our background, and then Stephen, also some of your experiences too, because it all depends is the answer, and we'll have a lot to share. So how to find investment or how to find potential investors. It really depends on where you're sitting personally with your network and your experience. So if usually this is coming from people who don't obviously immediately have somebody that they can go call and be like, hey, would you invest in a company if I started it, or the company that I already started? So if it is that you have either a niche network or you don't have a large professional network in the investor space, the shortest answer is really start getting involved, taking a look around what's local to you, where entrepreneurship is happening in your city or the closest city to you. There are platforms like Gust. We literally have hundreds of investment groups that take applications. Investor groups are one source of funding. They're not the only source of funding. There's independent people, there's indie VC kind of, VC hacker sort of stuff, AngelList things, random people on Twitter are investors. So they're all over the place. But if you're starting from scratch, finding organizations can be very helpful. Accelerators, incubators, and investment groups. Those are people who have come together in an entity to actually systematize startup investing. So if your network's very small and you don't have people you can talk and start getting introductions, those are great places to start. Accelerators are usually investor adjacent, so they will help you take the next step and then also possibly introduce you to large parts of their network. Sometimes accelerators invest themselves. There's top tier ones like Y Combinator and Techstars. Stephen will actually speak to their experience with Techstars, I'm sure. And then there's all sorts of ones, and they're coming out of the woodwork every single day now. Some hyper specific, like they only serve to move you from idea to market validation. Others are general purpose. You enter their cohort and you basically get like a dedicated 3-month, 6-month, full-time job of being as part of the accelerator, and you can find them everywhere in between. So one of the things I like to say is attracting anybody to your business, whether it's a co-founder, an advisor, a potential investor, is just increasing your chances, or what we call the surface of serendipity. A lot of these things happen because you showed up and the right person was there at the right time. It's very difficult to just make it instantly happen, but the more you're out there, the more you're applying to, accelerators that are the right fit for the company, the more you're going to events, virtual and otherwise, the more you're participating in communities, the more chances of a serendipitous event to happen where that investor is like, I specifically invest in whatever, IoT companies in the health tech space that are at this stage. This company is like that. Maybe I will entertain that conversation. So that's the general purpose thing. And like I said, shameless self-promotion, gust.com/search is a completely free resource. We have hundreds of angel investment groups and hundreds of accelerators that have open applications at any given point. Some of the big luminaries like New York Angels, we used to have, there's some great ones. Midwest, a lot of angel investment is fairly local. So like if you're in Ohio or if you're in Portland or you're in Seattle, like look for local ones because they often have support organizations and they can connect you to other people, even if you're not a good fit for them at your given stage. So check out gust.com/search, completely free. Every once in a while, you'll find an organization that might have a small fee for pitching to them. It's increasingly rare and sometimes a red flag, but we specifically filter so that any of the groups on our platform are high quality groups that are part of an angel federation or something like that. That was a lot of talking. Steven, fill in some gaps there in your own experience.
Yeah, I'd love to. And man, I think Ryan hit the nail on the head, and the circle of serendipity and just kind of what I call kind of falling through the grapevine. It's just, it really is just getting out there and getting involved. I mean, I wish there was a silver bullet, but there's just not. And there's a reason for that. And that's that, investors invest in your company because they trust and believe in you and because they have confidence in you. And that trust is built over time, and it's a relationships game. So you really do just have to get out there and get involved, go to local events. I think the best resource, when I first got started and I didn't have a network of investors, I went to founders. Like I went directly to founders, because founders are really easy to get meetings with in a sense, because you can head up a founder and it's peer to peer. There's a lot of commonality there, and you can say, hey, I'm a new founder, maybe I'm a first time founder, or maybe I'm a serial founder, but I just need more investors in my network. I want to meet with other founders in my community. I want to meet with other founders in my space that maybe aren't competitive to me, but are tangential to me or complementary to me. And I want to build a relationship with them. And that takes time. Like you have to set up a meeting, you have to have maybe multiple meetings. But once you've built up a little bit of relationship there, those founders, they know investors, and you can use them to get in front of investors, and then ask those investors for a connection to an investor. And you just have to keep following that line. It takes time, and that's why I always tell investors start early. Like when I raised $750K in a pre-seed round 2 years ago when I launched Forecastr, I started meeting with investors. No joke. 12 months before I even asked for the first check, and that was because I knew aspirationally I wanted to start the company about a year from now. And I just started to have meetings with investors. I started to meet investors. I got them on a company update list. I asked them, who else do you know? I worked that grapevine and met. And over the course of the year, built up a nice investor network. I had them all on a monthly company update list. They had a history and a track record of my success. And so when I went to raise the round, I just hit up those investors and said, hey guys, like, remember that company we've been building for the last 12 months? Well, here we are, and we need some capital to reach these milestones. What do you think? And we got that round done. And what did I do when I closed that 750? I went right back to the well, and I was in Techstars at that point, to Ryan's point earlier. So I leveraged Techstars. Techstars is a huge network, so I was able to leverage Techstars, get a lot more of those investor meetings, constantly be meeting with investors, not a ton of meetings a week, just like one a week or whatever, but do that every week for 52 weeks, and boom, there's 50 investors, and you start building those relationships up way in advance of raising capital. So I wish there was a silver bullet, but really the grapevine and building those relationships over time, leveraging founders in your local community and your kind of tangential community from a space and sector perspective, those are really strong avenues. And then like LinkedIn's really powerful. You can back in the other way. You can take those tangential companies. You can use AngelList and Crunchbase and even like PitchBook if you have a subscription. Figure out who their investors are. Figure out those partners. Have LinkedIn and go get a contractor to like rip through your LinkedIn and get through all of them and find second-degree connections. Work those. Like there's no magical way, but it's just like you got to put in the time, energy, and effort to just work the network in that way. And just trust and know, that it does pay off. And it's really important. I think if you guys are wise to key in on that question, because what I've seen is that like at bats, essentially the quantity of investor meetings and not getting enough of them is one of the main reasons why people don't raise rounds. They run out of contacts and they don't have the meeting, and they don't have the round raised, and they just start to kind of lose momentum on the round, and that can really have negative effects. So make sure you do the hard work early on of building up those relationships so you can go in the round, with a lot of meetings. And that's how you build momentum. That's how you build scarcity. That's how you build FOMO. And that's how you get rounds done very quickly. I took 140 meetings in the month of January to raise that 2.5 million in 6 weeks. It wasn't, just a few meetings and some big checks. It was a lot of meetings, a lot of no's, but a lot of FOMO generated by having such a large volume of quality investor meetings. So yeah, that's what I would like to add, and I'll go ahead and jump into my financial model now, so we make sure we have enough time to walk through this.
Thank you so much.
So I'm going to flip over here and go over to the assumptions section and just kind of show you guys a little bit. So this is Forecastr, what you're looking at, and this is my financial model in Forecastr. This is Forecastr's real model. It's live. This is the model that we use to raise the seed round. It's the model that we use every month today to run the company. And so I wanted to kind of walk you guys through this to show you what it looks like to walk an investor through a financial model when you're raising capital. And the first thing I wanted to do is, just before we even dive into actually me kind of walking through this with you, I want to talk to you a little bit about how you do it. And so at a high level, I mentioned one thing already, which is that what you're trying to do is build trust and build confidence. And trust and confidence are built through FaceTime. So you want to sit down with an investor, and you want to focus that trust and that confidence in a particular area of your company, and that's the area of your company that's the most risky, and that's the revenue piece of your company. Investors are going to care a lot about how are you generating revenue, and I want to have confidence and I want to trust that you as a founder understand your revenue formula, how you're going to generate revenue, how you're going to acquire customers, what your business model is, so that I can have, trust and confidence that this area of your company is a little bit de-risked, and I'm trying to minimize risk as an investor. So, assumptions, that's kind of the backbone of any financial model. Assumptions is what drives the financial model. So that's the section that you want to spend the vast majority of your time in, is talking about the assumptions that you're making. Those assumptions are going to ultimately spit out a set of financial statements. You'll have historical data in your model, you'll have forecasted data in your model. You can look at it monthly and annually in Forecastr or Excel or what have you, but you want to kind of zoom in, zoom out. But those are the two main sections, financials and assumptions. Within assumptions, you want to kind of walk from the start to the finish of your business, so to speak. So you want to start with customer acquisition, and we'll come back to this in a second. You want to get investors really comfortable with the fact that you understand how to acquire customers, and you understand what kind of channels you're going to use and what's your go-to-market look like and how you're going to scale it. So you're going to talk about that. Then you're going to walk an investor through, hey, once we acquire all those customers, here's how we monetize them. Here's what our revenues look like to date, and here's what it's supposed to look like here in the next 6 to 12 months. Here's our milestone for the Series A. You're going to talk to them a little bit about monetization and milestones. Then you're going to say, hey, that revenue forecast is great, but if we're going to achieve that, we got to hire people. We need resources. Who do we need? When do we need them? Why do we need them? You're going to talk to them about that. Then you're going to talk to them about your expenses. What other expenses do you expect to incur beyond just your people, which is largely going to be your biggest expense? If you have a physical product company, or you have kind of a complicated balance sheet, what kind of assets might you have? Do you have any fixed equipment or fixed assets or equipment, or do you have any inventory? Is there any debt that the investor needs to know about? But ultimately, where you're going to end up is on the fundraising side. You're going to end up saying, hey, we've got a great revenue forecast. We've got these milestones we need to hit. We got to hire these people, and this is what it looks like. We need 18 months worth of runway to do that. So we need to raise a $2.5 million seed. Let's talk about that, right? That's why you're there with the investors, to talk about the round that you're raising, and you want to get them in on it. So end with that, right? Don't lead with that. Lead with your business, and lead with understanding the most critical piece of your business. Get them to really get pumped up about that, and they're like, wow, man, Ryan really understands his business. He totally gets it. You can walk me through it inside and out. I got a ton of confidence in Ryan. Now he's asking me for money at the end, and I'm a lot more interested than if he just asked me for that right out the gate. And I'm like, well, do you even understand how you're making money? And so that's kind of the order of operations here. It's step them through the business, focus on revenue and assumptions. Then you maybe zoom out to say, hey, if all this holds true, bang, this is how big our business can get. Huge pot of gold at the end of the rainbow. We need $2.5 million right now to reach these milestones and buy these people and get this much time. So that is, generally speaking, how you want to do it. Now, the next piece is when I start to do this, right, and I'm walking an investor through my revenue formula, if you will, how I acquire, how I monetize. I don't just dive straight into the deep end. I'm not just like, and we're going to do this paid advertising strategy. We're going to start with $1,000 budget and blah, 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 blah. Like, the investor doesn't really want to hear all that. What they want to know is that you know strategically what's the most important. So start high level and start with strategy, and let the investor ask questions where they want to focus and show that you can do that. So I'll give you guys a chance to do this in just a second. So I might say, hey, customer acquisition, that's huge for us. Like, distribution is how we win this space. We want to own the financial modeling space for startups. Customer acquisition is how we're going to do that. We believe there are 2 or 3 major strategies that are the most important for this business. Strategic networks is how we're acquiring the vast majority of our customers. If I look historically, the vast majority of our customers historically have been acquired through strategic networks. These are accelerators, these are VCs, these are amazing partners like Gust. These are natural communities of founders where we can get in and we can show, hey, we really know how to build financial models. We're experts in this. We can build that credibility, and we get a lot of customers from that because we know what we're talking about. And that's something that we want to scale. Founders don't search for this stuff on Google. They look to a partner, they look to an accelerator, they look to an investor, they look to a peer founder. So it's going to be really referrals driven. We know that. We're leaning in on that. And we've already locked in partnerships with Techstars and with Gust and with NewChip and with these major partners. So I talked a little bit strategically about our most important channel. I'd say, we think viral loops are going to be really important. Investors are going to tell founders, founders are going to tell investors. It's going to percolate through the market. How do we do that? We lean into creating value for both sides. In thought leadership, that's ultimately what we're selling. We're selling credibility. We're selling our expertise. So we need to provide a lot of thought leadership to the market. If we do that, we believe that we can go from selling 30 customers a month on average right now to scaling that up to just over 70 or 80 customers by the end of next year, well over 100 or 200 customers by the end of 2023, and on through. We'll talk about the revenue in just a minute, but those are our most important customer acquisition channels. That's how we're going to market. That's how we plan to scale. Do you have any questions that you want to ask about customer acquisition? Any channels you want to dive into before we jump over into revenue? And then there, you're giving the investor an opportunity to say, hey, yeah, I do have a question. I want to talk about this channel. I want to talk about that one. Or they say, no, I think that makes sense. Like, let's talk about how you monetize. So I'll let Ryan, you see if there's any questions in the chat people want to ask, or if there's anything you want to ask. I'm happy to dive into that, or I'll move on and talk a little bit about revenue as well.
I think people are mostly stunned in the chat. We haven't had a question yet once you started to dive into this post fundraising. So
Okay.
Just keep going and we'll scoop them up at the end. We got about 15 minutes left here.
Okay, cool. So you're kind of getting I think a theme here where I kind of say, okay, high level strategy, hit on the most punchy pieces, the important assumptions that an investor really needs to believe if they're to believe in you and your company, and then pause and ask for questions, and only dive deep where the investor wants you to dive deep, because you may dive really deep into something that they don't care about, and that's just a waste of time. So keep it high level, let them ask questions, dive deep, and in that way, you're showing them that you can answer those tough questions, right? They're going to throw some questions at you. You got to be ready to answer them. So you go over to revenue, you're going to do the same thing. You're going to say, now, acquisition is just half the story. That's how we acquire customers, but customers by themselves don't generate any value. We got to turn those customers into dollars. That's how we make money. That's how we build a profitable business, and we do that in 2 ways. The first way, our bread and butter, that's our annual subscription. Sticker price is $2,000 a year. Gust companies get 25% off, so $1,500, by the way. But sticker price is $2,000 a year. We sell an annual subscription to this software. We've got a 30-day white glove onboarding where our team of financial modeling experts works hand in hand with our customers to get them a great financial model. After that, it's a self-service solution, email and live chat for free, but we offer paid support plans on a monthly basis between $500 and $2,500 a month to provide ongoing support to our companies to ensure that they maintain financial health and financial hygiene. So boom, I just kind of give a nice overview of our business model, a little bit of pricing. So I might just like wash over it like that. I might close out services to say, right now you can see annual SaaS, that's our bread and butter. It's the lion's share of our revenue. Through to the Series A, we believe that we're raising Series A out here. It's going to be about a 75-25 split. Our services is going to be about 25% of our revenue, and our SaaS is going to be about 75%. Now, I might also zoom out here to say, now, this is how it looks like on a monthly basis. If I zoom out to show you big picture, and this is where I might plug a vision statement, our vision is to become the default operating system for FP&A in the venture-backed ecosystem. The way we do that is by, yes, acquiring these early stage startups at a reasonable price point, like $2,000, but it's by growing with them and evolving the value of the product and selling a growth package for 5 to 10K to Series A and Series B companies, or a scale package from 10 to 25K annually for Series B and beyond. That's really the gem of the market. That's where a lot of the revenue can be generated. You can see that here in the model, that the vast majority of that revenue, right? So it's backing up the story that I'm telling orally. That's where the lion's share of the revenue is generated, is by these later stage companies that we're growing with, and we're acquiring people into launch and then upgrading them over time as they need more and more from us. We can provide that through our product and through our services. So you can see, how our business evolves. It's an opportunity for me to tell the vision of the company and how we're going to grow into alternative customer segments. And you can see how services kind of grows alongside it, but becomes a smaller and smaller and smaller piece of the total revenue picture, because we're not a services business. We're a software business, and that's what I would communicate, because I want to look at this $100 million in revenue, and I want to say, hey, this is going to be an 8x multiple at exit or a 10x multiple at exit. I can't say that if services is a huge piece of it. So it's narrative based, right? I'm telling that narrative, I'm telling that story, I'm not digging in deep, I'm pausing again. I'm saying, hey, if you've got any questions, let me know, because this is really the meat and potatoes of it, right? This is how we acquire customers and how we monetize those customers. Would love to talk about our business model, our unit economics, right? That's really key. And if you don't have any questions about revenue, then, ultimately, if we're to achieve this revenue forecast, if we are to hit these milestones, we got to hire people. We need a great team in order to do that. And we have a really thoughtful hiring plan that I'd love to walk you through. And I might step them down to that hiring plan to do that. And on the hiring plan, it's the same strategy. It's like, don't overwhelm them with information, just hit on the highlights that I might hit on, or like, what are the roles that you think you're going to hire a bunch of? Like, for me, I know I need developers to build, I need analysts to onboard, and I need sales reps to sell. Those are the people that I need to have a bunch of in my company. So am I modeling those all out individually? No. I am saying, hey, analysts, I know that it takes a certain amount of service hours to onboard a new customer and to service an ongoing customer, to do those support packages. So I'm automatically hiring analysts whenever I need them. I've already got 6 analysts, so here those are. On the sales rep side, I'm expecting a 25 deal a month quota, so I'm automatically hiring my next rep June of 2022, and I'm going to hire them on beyond that. Every time I need 25 extra, new customers, I know I need a new sales rep. And on the developer side, I'm hiring a few developers every 3 months post the Series A. Here's my developers that I'm hiring before the Series A. And I might talk a little bit about some skill gaps. I might say, look, we got a skill gap in product. We've got to fill that. Product is a huge strategic lever for the company. We've got to win on product. We're hiring for product executives. We're hiring for a marketing executive as well. It's not a core competency across the founding team. So these are the areas and the strategic hires that we need to fill in order to generate the customers, in order to generate the product value, in order to hit that revenue milestone, which is the anchor of the presentation. And then you're going to keep on going. But these 3 sections are the vast majority of it. If you can get an investor to believe that, you've got customer acquisition on lock, you understand how you're going to monetize, and you know who you need to hire over the next 18 to 24 months, I think you've won the battle. At that point, you're pretty much saying, look, if we can execute on this model like I think we can build a really big, attractive business that you're going to want to invest in. And I can, pull that out to tell them, to show the investor, look, this is a big business. This can be a $1 billion business, and it's not flying off the page. I'm reasonable. And this ramp is reasonable. Look, I'm losing money for the next 4 years. I understand what it takes to build a venture scalable company. I'm not, I'm not just like generating an enormous amount of profit like some models do and showing that I
Nothing to the
don't
right.
really understand how some of these mechanics work. I'm really showing the investor that, hey, like I've got a reasonable path here, and if I'm going to hit this path, what I need right now is 2.5 million or 1.5 million or 750K, whatever it is. You're anchoring at the end back at that conversation at hand so that you can answer any final questions, set up and establish a clear next step for the investment, and then boom, you've essentially kind of closed out the meeting. So that
Awesome.
is what I got in terms of walking an investor through a financial model, and hopefully that's really helpful to you guys. So.
Yeah, we got a couple questions I'll serve up in a second, and I just wanted to highlight one thing in that point because it's something that we've seen a lot sitting on both the kind of investor and founder side of it is there's often a weird duality to startup investment that investors are investing in seemingly impossible ideas. So therefore, they should be willing to give money to something that seems impossible. But they're grounded in real rational financial literacy. Most of these people are trying to make an ROI on their investments as a portfolio play. And so often it seems like, oh, I'm pitching like the next big thing. Why doesn't somebody just give me a bet on this business that could be a potentially billion-dollar business? And the core of this is exactly how investors think, which is if you find an impossibility in your model that's actually impossible in the world. And I think one of the best examples is a lot of times in early product pricing, founders will think of like, well, I can sell to these certain people, like I can make this much money if I drag the spreadsheet out to the right far enough, it eventually becomes $100 million company. But what's nice about this financial model based on hires, costs of goods, acquisition, is you can start to see impossibilities pop out where it's like, okay, this will work. All I have to do is get 4 billion customers. Then you can like walk back and be like, oh, I'm a B2B enterprise SaaS company. There aren't 4 billion companies that I can sell to. So maybe I need to reconsider how I'm building this, what my pricing is, what my growth is, how we approach the things like that. And it sounds really silly, but it's incredibly common for founders to be extremely passionate about a market, have a product or a solution that's doing something, but it not actually have a sustainable or a growable model underneath it because it's based on assumptions that actually just don't hold any water in the real world, even if it's a moonshot idea. But thank you so much for all that, Stephen. We got a couple questions I want to get through. Easy ones first. If I already have a financial model in Google Sheets, can I upload it to Forecastr? Is there an easy way to get things set up?
Yes, absolutely. That will make our job even easier, and that is what the white glove onboarding is really meant to service. And so we work with a lot of companies that already have financial models in Google Sheets or Excel. As a part of the onboarding, you'll be assigned an analyst, and that analyst will take that model, and they'll either load it up for you in Forecastr and provide advice on how to improve it, or if you have things that you like and don't like about that model, the analyst will bait that out of you as well to understand, hey, like, do you want me to use this model as a reference? Do you really like how this model is structured, or is this just a model that you have? They'll take that in, they'll use that to build that first draft of the model, which they'll present to you in Forecastr on your kickoff call. And then over the next 30 days, they'll work with you to improve and sharpen that model into the best possible financial model for your company.
Excellent. Next up, we have a Forecastr customer already. Kim asks, she's a Forecastr customer and she uses the base case as her pre-money reality. They're already a business with some revenue. And then she has two scenarios for growth plans that require investment. Should I use the base case when approaching an investor or my growth scenario?
Yeah, so I would definitely use the growth scenario because ultimately you're asking the investor for investment. So you want to be showing them a case that's only true if you get investment, because ultimately you want to show them a case that's really exciting and that says, hey, like, here's how much we can grow. But if we're going to do that, we've got to raise this much money. We need this much money to invest in these resources and hit these milestones. So I think it's great to have a base case, kind of a cash flow planning case, if you will, where you don't need investment. We do the same thing. But I would position the model with the investor as the growth case. That's what I would walk through with them first. And I would focus on that one.
Wonderful. And other simple question, Sheldon asks, does this carry well over to Canada?
Yeah, we've got a lot of Canadian customers. We've got a lot of customers over in the EU as well. We've actually got customers in every continent outside of Antarctica. We haven't sold the science lab yet, but hopefully we'll get that one done too. So yes, we have Canadian dollars and lots of other currencies and things like that in the model as well. So great question.
Awesome. And Carlos is asking to double down a little bit on what you were just talking about with the service. Forecastr experts are actually building the model for your customers.
They can. We typically like to build it with the customer, so it's kind of a done with you process is their recommended approach, where the expert will build some of that initial structure, really the first draft of the model, and then they'll work with you in a collaborative way over the 30 days to shape that model, to iterate on it, to add some people, to shape those assumptions, and arrive at a forecast that's attractive and reasonable. So that's usually the recommended approach. It's kind of a split where you're focused on inputting the assumptions into the model. The analysts are driving the structure of the model and the underlying mechanics to make sure it's really sound. Some of our customers, though, opt for a done-for-you approach, where the analyst will literally soup to nuts, build the whole model, put in all the assumptions, do everything that they can do to make it the best possible model. It doesn't tend to be as good of a model because they don't have as much context as you do about the business, so that's really helpful to have that. But we do also recognize that, look, sometimes founders are really busy. I am, and sometimes they need a little bit of extra help, so we lean in and provide that help when necessary. There's also a done by you approach where the analyst really serves in a more advisory role and really coaches you how to build the model in Forecastr, so you're really flexing the muscle and you're really learning how to do it. So we try to be flexible and offer different approaches for different founders with different needs.
Awesome. You got some love in the chat too. Kim says that Kevin and Zach were awesome in getting her model set up. So yeah, I will say everybody we've sent to Forecastr comes back raving. So that's why we keep doing these events. It seems really helpful for people, and they're very just spiritually aligned with what we're trying to do, both as companies and helping startups out. So last question, and we'll be right at time. I asked for some clarity, but I didn't get it from David. But I believe his question, and this is kind of a fun one to maybe end it on, because it'll put your sales chops at test. I think he asks, how will you, Stephen, finally convince him to use Forecastr?
Oh, wow. Okay. Well, here's what I would say. When you are thinking about building your business and kind of scaling your business, I think you should think about the fact that as a founder, you have incredibly limited time, and you have to focus your time in the most efficient way to achieve the most results the quickest, right? It's like, I don't have ever enough time to do everything I want to do in a day, so I've got to just maximize my time as much as possible. And any time you spend kind of invested in like what I would consider kind of an orphaned appendage to your business, like this Excel spreadsheet that you're monkeying around in, building a bunch of formulas, doing a bunch of manual data entry, it's by definition non-strategic time. It's kind of eventually going to be wasted time, and that model isn't plugged up to the rest of the data that lives online in the cloud. But I think if you work with Forecastr, we can supercharge that process. We can take a lot of that upfront burden off your plate, so you get a better model and you get it faster. And then once you have a model, you have a place to manage it in a way that's connected with your accounting and your other data. It's automated, it's smart, it's immediately shared with investors and your co-founders. It's a lot more scalable. And so you can use that time doing what you want to do, which is probably building your product and probably selling some customers. So that's what I would say, Dave.
Awesome. Stephen, we had, of course, at the end, we had like 5 more questions pop in. Do you have a little bit of time to clean these up, or do you have to run?
I do have a few minutes, yeah.
Cool, because they're about your product, and there's also a lot of praise and love, so good for you. One question just came in from Sheldon. How can you have 2 models available at one time, like one for the data room, one as a working business model?
Yeah, so the way that works, at least like in Forecastr, we have something called scenarios. So I guess in this one, I've only got my base case shared, but essentially you have a variety of models that can live, and they're just like different expressions of your model. So you have kind of core mechanics, the guts, the simulating engine of your model, and then you have different sets of assumptions which produce different sets of forecasts. And in Forecastr, you can create as many as you want. So we can open up this drop down here. You see we have a base case, we have a worst case, and we have a worst case with cost cutting. We've got a little test that we're doing on some different revenue streams. And then here in the settings, you can set investor access links for different versions of the model. Your base case, all your cases, etc. You can use any of these cases internally, and you can share only the cases that you want to share with investors. And it's really easy to just kind of click in here, clone it, make a new copy, and get going on that.
Excellent. And let's see, I think we have two more. Lots of love. Bye, Ivy. Brittany Ford asks, are there flexible sections to add real estate investment pro formas?
Real estate investment performance. Yes. So we do have a few real estate companies that we work with, and there's really kind of no problems there. The only thing that we can't do right now is if you're like a REIT, if you're like a real estate investment fund or something like that, there are some fund dynamics that Forecastr gets a little choked up on. But if you just have like a real estate model where you have properties and you're managing them and they're generating income, or you're selling them as that, like that kind of stuff, that's no problem. Our analysts can help you with that.
Awesome. And the last question, I don't think we drilled down on it too much, but I will use this as my I'm bad at marketing our own stuff approach. But Stanley asks, he's in a new industry and he's trying to get investment ASAP. What's the price point? So Stephen mentioned it kind of in situ of other things. But if you're at this webinar, or if you're a Gust launch customer, we have negotiated a 25% discount on their services, including that high touch onboarding and 30-day support stuff. So I believe their list price is $2,000. But if you go through Gust, and there will be a special link sent out to everybody about 2 hours after this wraps up, and that link will have all this information and more resources, even a personal note from Stephen and Logan that they wrote us, as well as a link to how to redeem the 25% discount, making it only $1,500 for your first year. Did I get that all right, Stephen?
Yep, nailed it.
Awesome. Well, that cleans up all the questions. I always love at the end, like, questions inspire other questions. So there's always a nice little flurry of them, but they were super relevant. And I will say this is almost the year anniversary of us kind of doing stuff with these guys, and just seeing the change in the platform from last January or last December or so to now. It's like the scenario analysis, like the various imports and things like that. It's awesome. They're still building. And responding to feedback and what they get in their customers. So any other context you want to add, Stephen, before we sign off?
No, just an expression of gratitude. Really appreciate everybody, sticking in here with me today, and I really hope it was valuable. I want to be of service to you, beyond this as well. So, like Ryan said, you get a bunch of resources from us. Please do contact us if you want to use Forecastr, if you just want extra advice, like that kind of thing. My email is steven@forecastr.co. Please email me anytime. And just best of luck building your businesses. Go out there and crush it.
Yeah. From both of us, have a great week. Have a great holiday. Look out for some future events with the Forecastr team in the new year. We're probably going to get one monthly. The 3 that we've been going through is this one on fundraising, which is very specific to fundraising. Just general how to build your model from scratch, that demonstrates kind of how they would work with you in building it, and just good principles. And then also one on how to use it for operations. It sounds like there are some like revenue, maybe profitable businesses which aren't necessarily running after investors, but day-to-day decision making is very much improved by having a good financial model that's kind of matched up with your reality. So look out for invites to them in the new year. Stay safe, everyone. Have a great holiday, and thanks a lot, Stephen.
Later, y'all. Thanks, Ryan.
Bye.